This is backstory. In 1998, the smartest fund on Wall Street almost destroyed the financial system. Not because they were reckless, because they were brilliant. They had no Nobel Prize winners, the best mathematical models in finance, and the confidence of every major bank on earth. They believed they had found something rare in markets, a machine for certainty. They were wrong. It was called long-term capital management, LTCM, founded in 1994 by legendary bond trader John Meriwether, and backed by some of the most respected minds in economics and quantitative finance. This wasn't a reckless hedge fund. This was Wall Street's intellectual elite. The pitch was simple. Markets are inefficient. Prices deviate. Eventually, they converge. And if you can model those tiny mispricings correctly, you can make money almost without risk, not by guessing, by calculation. LTCM didn't make wild bets. It made elegant ones. They bet on tiny differences between similar assets, believing those gaps would close over time. Normally, the profits were small, so they used leverage, massive leverage. For every dollar of capital, they borrowed far more, turning tiny edges into enormous positions. And for a while, it worked beautifully. Their returns were extraordinary. Wall Street was mesmerized. Banks lined up to lend to them, because when genius is making money, nobody wants to ask what happens if it's wrong. Then came 1998. Russia defaulted on its debt, and suddenly the world stopped behaving like a textbook. The relationships LTCM depended on broke. Spreads didn't converge. They exploded apart. The model said one thing, reality did another. Markets stopped acting rationally, and that was the problem. Because LTCM wasn't built for panic. It was built for normality. And when the world became abnormal, their system began to tear. The losses were immediate, then violent, then existential. LTCM had borrowed so much and become so deeply connected to the global financial system that its collapse was no longer just its own problem. It was everyone's. Major banks were exposed. Counterparties were entangled. Positions were too large to unwind cleanly. And suddenly, Wall Street faced a terrifying question. What happens when the smartest people in the room blow up? The Federal Reserve stepped in, not with a public bailout, but with something quieter, a rescue. Behind closed doors, the biggest banks in America were pushed into a coordinated intervention to prevent LTCM from collapsing in disorder. Because if they failed all at once, the damage could spread everywhere. The fund that was supposed to understand risk better than anyone had become systemic risk itself. LTCM didn't fail because the people were stupid. They failed because they mistook probability for control. Their models weren't useless. They were just incomplete. Because in finance, what kills you is rarely what's probable. It's what you believed could never happen. And once enough people build the same elegant system, the system stops being protection, it becomes fragility. Long-term capital management almost collapsed the financial system 4 years before 2008, and the warning was clear. Complexity does not remove risk. It often hides it. So here's the real question. If the smartest people in finance can build a system this fragile, what does that say about the systems we trust today? This was Backstory by Origins. Thank you for watching. Please subscribe and share with your friends.